In this episode, Lily will be delving into the financial statements of InnovateTech, a publicly traded company in the burgeoning tech sector. Our task is to dissect their performance, identify key metrics, and ultimately assess whether this presents a compelling investment opportunity for our listeners.
Precisely, Sophia. We'll be examining their revenue growth, profitability margins, debt levels, and cash flow, comparing these figures to industry benchmarks, and highlighting any potential red flags that a prudent investor should be aware of. A thorough analysis will be crucial in forming an informed opinion.
Let's begin with revenue growth. InnovateTech has shown impressive top-line expansion over the past 3 years, averaging a 25% year-on-year increase. This surpasses the industry average of 15%, suggesting strong market demand for their products or services. However, we need to scrutinize the underlying factors driving this growth. Is it organic growth, strategic acquisitions, or a combination of both?
Absolutely. A closer look at their segmented revenue reveals a significant portion stemming from the recent acquisition of DataStream, a smaller competitor. While this boosted their immediate revenue figures, it's crucial to assess the long-term synergy and integration success. Relying heavily on acquisitions to fuel growth can be a risky strategy in the long run.
Moving on to profitability, we see a mixed picture. While revenue has surged, their net profit margins have remained relatively stagnant, hovering around 8%. This is below the industry average of 12%, indicating potential inefficiencies in their operational structure or perhaps aggressive pricing strategies to maintain market share.
Indeed, we need to investigate their cost structure. Are they investing heavily in R&D, which could justify lower immediate margins in exchange for future growth prospects? Or are there areas of cost optimization that could be explored to improve profitability? A detailed analysis of their cost of goods sold and operating expenses is imperative.
A key area of concern lies in their debt levels. InnovateTech's debt-to-equity ratio has increased significantly over the past year, reaching 0.8. While not alarmingly high in isolation, coupled with the relatively low profit margins, this indicates a potential vulnerability to economic downturns or interest rate hikes.
Precisely. The increased debt could be attributed to the DataStream acquisition, which is often financed through debt. We need to examine the terms of this debt. Is it short-term or long-term? What is the interest rate? Understanding their debt repayment schedule and capacity is critical in evaluating their financial stability.
Analyzing their cash flow statement provides a more holistic view of their financial health. We observe strong operating cash flow, which suggests that their core business operations are generating sufficient cash to support their ongoing activities. However, their free cash flow, after accounting for capital expenditures, is somewhat lower than expected, potentially pointing to significant investments in new technologies or infrastructure.
That's a valuable point. While investments in R&D and infrastructure are crucial for long-term growth, overly aggressive capital expenditures can strain their cash reserves, especially in the context of their already high debt levels. A careful balance is needed.
Let's briefly touch on their working capital management. Their inventory turnover ratio appears healthy, suggesting efficient management of their inventory levels. However, their accounts receivable turnover could be improved, suggesting potential challenges in collecting payments from customers.
That's an excellent observation, Sophia. Slow-paying customers can significantly impact cash flow and liquidity. We need to investigate the reasons behind the slower-than-average collection times. Are they facing credit risks with their customers, or is it a matter of internal process inefficiencies?
Before we move on, I must admit, this financial analysis is proving far more complex than initially anticipated. It's almost like trying to solve a particularly challenging Rubik's Cube. At least we have a good selection of tools at our disposal to untangle this corporate enigma.
A very apt analogy, Sophia. The intricacies of financial statements often feel like navigating a complex puzzle, but that's what makes this work so intellectually stimulating.
And now, let's look at some industry benchmarks. Compared to its competitors, InnovateTech holds a competitive edge in terms of revenue growth, but lags behind in profitability and debt management. This suggests that while they are successfully capturing market share, they need to improve their operational efficiency and control their debt levels.
Precisely. This points to a need for strategic adjustments, perhaps a reevaluation of their pricing strategies, a focus on operational streamlining, or perhaps exploring alternative financing options to reduce their debt burden.
Considering all the factors we've analyzed, what is your overall assessment, Lily? Is InnovateTech a good investment opportunity?
Based on our analysis, the picture is somewhat mixed. While the company demonstrates impressive revenue growth and strong operating cash flow, several red flags remain. The relatively low profit margins, high debt levels, and potential issues with accounts receivable require further investigation and careful consideration.
I concur. The rapid revenue growth fueled by acquisitions is a double-edged sword. While it creates a positive impression on the surface, it's essential to assess the sustainability and long-term profitability of this growth. The high debt levels also present a considerable risk.
Therefore, we recommend a cautious approach. Further due diligence is necessary, including a deep dive into the details of the DataStream acquisition, a thorough assessment of their cost structure and debt repayment capacity, and a review of their credit risk management policies.
Indeed. Our analysis highlights the importance of conducting comprehensive due diligence before making any investment decisions. It's not just about looking at the headline numbers, it's about understanding the underlying drivers of performance and identifying potential risks.
Precisely. Remember, listeners, investing always involves risk. No analysis, however thorough, can eliminate all uncertainty. This analysis should serve as a framework for further investigation and inform your own due diligence process.
And speaking of uncertainty, I'm reminded of the old Wall Street adage, the market can stay irrational longer than you can stay solvent. A sobering thought, but one that underscores the importance of thorough analysis and risk management.
A perfect ending, Sophia. It encapsulates the unpredictable nature of the market, a constant reminder for all investors.
Before we conclude, let's reiterate that this podcast is for informational purposes only and should not be construed as financial advice. Consult with a qualified financial advisor before making any investment decisions.